The UK budget is going to extract billions from the wealthy. Dividend tax up, property tax up, income thresholds frozen again. But here's what this budget actually revealed. 3 tax mistakes that were already costing UK business owners hundreds of thousands each year. And now they're costing even more. My team and I have worked with wealthy entrepreneurs paying over £250,000 in annual tax for a combined 30 years. After this budget, every one of these 3 common mistakes just got even more expensive. So in this video, I'm going to show you what these 3 mistakes are, why this budget made them even worse, and how to fix them. Real case studies, not theory. Disclaimer, this isn't advice of any kind. It's for educational purposes only. Let's get into it. Richard is a property developer in Manchester. He runs 2 companies, a trading company doing about 280k a year and a holding company that invests in startups and property. He has been smart about tax. He kept his personal bill low through dividend extraction, and his UK accountant reviewed everything each year and told him the same thing every time. You're optimized. But here's what his accountant didn't see coming. Richard had multiple development projects about to pay out. We're talking £4 to £8 million landing in his account within 12 months. When that money hit, his tax situation was going to explode. Under UK rules, he was looking at £800,000 to £1.6 million in capital gains tax on a single payout. Richard came to us and said, "My accountant's plan is to reduce it down to at least below £1 million. Not bad, but limited." And here's the thing about UK accountants, and I'm not criticizing them. This is just the reality. They're trained in UK tax law. They're regulated by UK bodies. Their insurance covers UK advice. When you have a cross-border problem, they are operating outside of their expertise, and they don't always know it. By the way, if this is already sounding familiar, there's a link in the description to book a complimentary structure review with my team. But keep watching because I really want to show you exactly what we did for Richard. So what did we do differently? We built Richard a structure that his UK accountant couldn't have built. An international holding company in a stable, private jurisdiction. An operating entity positioned to receive the payout at significantly lower rates. Now he had asset protection layers that he didn't have before. This architecture required expertise across multiple jurisdictions, banking relationships, and substance requirements that his accountant just doesn't have the answer to. When that £4 to £8 million payout arrives, instead of at least £1 million going to HMRC, Richard is now only liable for 400k. So we saved him 600 grand in just one transaction. Same money, different structure, completely different outcome. And this is exactly why the budget matters. Everything that Richard's accountant recommended just got even more expensive. Dividend tax up by 2%, property income tax up by 2%, and every UK extraction strategy is now costing you more. Richard's accountant wasn't bad. He just couldn't see beyond the UK system. And that is the first mistake that wealthy UK entrepreneurs use. Trusting UK-only advisors to solve what is fundamentally a cross-border problem. If your advisors only know UK rules, then they can only give you UK outcomes. Now let me tell you about James. James sold his UK company for £56 million. By any measure, he was financially successful. When I met James, he was still angry. Not about the sale of the company, but about what happened next. James went through a divorce, and in that divorce, he lost £6.8 million. Now, James had done what most successful people do. He had a UK limited company, a holding company, trusts. So on paper, it looked protected, but it wasn't. The family courts looked at his holding company and said, "You control it? All right, that is a matrimonial asset." His UK trusts, easily provable that he controls the whole thing. The courts included everything in the settlement. £6.8 million gone. Not because James did anything wrong, but because UK structures weren't built to protect wealth at that level. So when James came to us, he had 3 goals. 1, protect his remaining wealth so that no future relationship could ever touch it again without his consent. 2, secure his legacy for his 4 children with ironclad inheritance protection. 3, never feel that exposed again. So we built James a completely different architecture. A foundation structure in a favorable jurisdiction. This isn't like a UK trust. It's irrevocable. Once assets are inside, they are legally separated from James personally. Future relationships, creditors, lawsuits, they can't reach what he doesn't own. Then we had a holding layer in a stable, private jurisdiction for wealth management and an operating entity for his active investments. James ultimately controls all of it, but he doesn't own any of it personally. The foundation owns the structure. So his £35 million is now protected across multiple jurisdictions. His children's inheritance is secured inside the foundation with defined distribution rules, all fully above board, legally compliant and documented. And James sleeps like a rich baby, knowing that his wealth is now untouchable. This is exactly why the budget matters for asset protection. It introduced new council tax surcharge on properties over £2 million. If your home is worth £5 million plus, that's £7,500 a year in new tax. The pattern is clear. The UK government is identifying where wealth sits and finding new ways to reach it. If your assets are personally owned or in a UK trust, you are an easy target. And that's what James learnt the hard way. James's mistake wasn't the divorce. It was believing that UK structures would protect him. They weren't designed for that. They were designed to operate within the UK system, a system that can reach anything that you own. And that's the second mistake, having no real asset protection. Real protection means separating yourself from your assets legally, structurally, and across multiple jurisdictions. Now let me tell you about Joseph. Joseph owns an electrical contracting business in Berkshire. £1.2 million in revenue, about 80k in profit, and he pays himself another 80k salary. When Joseph sat down with us, he said something that I'll never forget. If I don't do this now, I never will. He was 55 years old and he's been running his business for 30 years. He built it from nothing. He employs 7 people, supports his family, wife, 3 kids, and after 30 years, here's what he had to show for it. Between corporation tax at 25% and personal income tax at 45%, Joseph was working nearly 4 months of every year just for HMRC. On paper, he was earning £160,000. In reality, he was keeping barely 50k after everything. So Joseph asked his UK accountant if there was anything that he could do. The answer? That's just how it works. And Joseph believed it. For years, he believed he was trapped, that the UK system was the only option. And at the age of 55, he thought it was too late to change anything. That belief was the most expensive thing that Joseph owned. We showed Joseph that it doesn't have to work that way. We structured a US corporation as his new operating vehicle. Flat 21% corporate tax rate. His UK company didn't close, it became a supplier of the US entity. Profits shifted from 45% personal plus 25% corporate to a flat 21% on everything. We aligned his business investment with property acquisition in Florida, qualifying him for residency through his own company. The result? Joseph was able to relocate his family to West Palm Beach. His 12-year-old son is growing up in America. His effective tax rate dropped from roughly 50% to combined 21%. Same skills, same business, same revenue, completely different life. And this is exactly why the budget matters if you feel stuck. It extended the income tax threshold freeze until 2031. That's 6 more years of fiscal drag. 6 more years of paying more without the announced rate increase. The UK system is counting on you to accept this. They're counting on you believing, like Joseph did, that there is no alternative. Joseph's accountant wasn't lying. From inside the UK system, there wasn't anything more to do. But Joseph's mistake was believing that the UK system was his only option. That is the third mistake, and it's the most expensive one. Believing that you're trapped. Joseph was 55 and thought that it was too late. It wasn't. Whatever your age or situation, you have more options than you think. 3 stories, 3 mistakes, 3 different outcomes. Richard trusted UK advisors with a cross-border problem, which nearly cost him over £1 million. Fixed it. We saved him 600 grand in one transaction. James trusted UK structures to protect his wealth and lost £6.8 million in a divorce. Fixed it. £35 million now protected. Joseph believed that he was trapped, kept barely half of what he earned for 30 years. Fixed it. 21% tax rate, new residency in Florida. If you're paying more than 250k in annual tax and you're serious about fixing that, book a complimentary private review of your setup with my team. If you recognize yourself in any of these stories, watch my next video where I break down exactly how we build these structures, how we help entrepreneurs shift profit legally, reduce their tax burden from 40 to 55% to at least 21%, often close to zero, and build real asset protection. It's on screen now, and remember, stay sovereign.